Hi guys, thanks for tuning in to another episode of Nuggets News, and today we welcome back Martin North for our March update on the Australian economy and the housing market. How are you going, Martin?
Pretty good. How are you?
Good, thanks. And to start off with, congratulations on your part in our documentary. It's up to 85,000 views as of time of recording, and it's great to see that message that we've all been pushing is sort of getting out there.
Yeah, it's good, isn't it? And lots of positive comments too. So well done, Alex. That was great. Great work.
And thank you again. So let's jump into our slides. We're going to go over 10 or 11 data points that assess the Australian economy. And the first one is our housing credit. And it's actually still growing, which goes against what a lot of people are saying out there in the mainstream.
Yeah, so it's interesting. This is the RBA data. So it shows the actual amount of credit in the system is still growing. So housing lending overall is still growing at 4.4% per annum, which is above inflation and, of course, wages growth. But owner-occupied lending growth is still growing at 6.2%. So we've seen the slide in investment lending down, to about 1%.
Yep.
The other observation is that business lending is still not actually that strong. It's growing a little bit, but overall, it's a really mixed picture. And finally, of course, personal credit is crashing. So we've seen a lot of households now struggling with just their overall financial footprint, and they're not borrowing as much, particularly on credit cards. But the point to make is housing credit is still growing very strongly.
Despite what we're kind of being told. And the next one is that credit impulse, and that is slowing a little bit. And this is one of our most important metrics, isn't it?
Yeah, it is. So credit impulse is essentially the rate of change of new credit growth, right? And the correlation, this is the ANZ data, shows that as the rate of change decreases, house prices slide. And that's one of the key modeling elements that I use in my core model. And essentially, whilst credit growth is slowing, the rate of increase is easing. And what that means is that overall, house prices have a lot further to fall than we've seen. So anybody who's spruiking, we've seen the turn, it's now time to prices to recover, citing perhaps auction clearance rates, are missing the point. The credit impulse is very clear. House prices are due to fall further.
And this is one of those points that goes to that whole narrative of the debt has to grow. It's not just we can't go sideways and plateau. The debt has to keep growing or we get into trouble, isn't it?
Yeah, that's right. So you need more and more and more debt. And, households are already debted out. We know that from all our data. So essentially what it means is that we've got less households who are able to borrow more, tighter lending and those sorts of things. That will simply put downward pressure on home prices.
Yeah. And then that leads to lower consumer confidence, which is the next one. And there's an uptick in the renters we've noticed, but other than that, everything's still on the slide.
That's right. Yeah. So this is basically from our surveys, and renters are finding that rentals are dropping a little. So 3% down in Sydney over the last year. So it's a little easier now to get rental accommodation. You pay a little less for it. It's more available. There's more property to be rented. But all the other people, those with mortgages and those without mortgages, are saying, gee, we're less confident now than we were a year ago. And that's to do with flat incomes. It's to do with the cost of living and perhaps some of those broader thematics now that are coming out in the, in the discussion up to the election as well. Yeah. Some uncertainties there. So there's a bunch of things going on. But the interesting thing is that the core constituency for the liberal side of politics, which will be those people without mortgages and, older people, perhaps more wealthy people, they're also now registering declines in confidence, which doesn't bode well for the election.
Yeah, just this morning I saw the headlines, the election, the battleground is going to be the economy, and one side saying, 28 years of growth, and the other side saying, look what you've done, sort of thing. So it's going to be fun to watch that unfold as well.
Yeah, well, we'll cover up the GDP number a bit later because that's a really critical number, I think.
Yeah. The next one we've got here is mortgage stress and more than 1 million homes. And would you like to explain the 31% figure for everyone at home as well, Martin?
Yeah. So what we do here is we look at cash flow, money in, money out, as you know, which basically tries to understand how households are feeling about their finances, and particularly those with mortgages. So now we've got just over 1,034,000 actually households registering as mortgage stress, and that's 31.4% of all owner-occupied borrowers. So it's a big proportion. We've never had that proportion of the households struggling with their mortgages. Remember, interest rates ultra low. Employment is very low. So we should be seeing this number much lower than it is. But it goes back to those same olds, right? Yeah. Cost of living rising, across the board pretty much, and income's not rising. And of course, people have big mortgages and they're highly leveraged, And there's been a little bit of an interest rate rise for some mortgage holders too. Put all that together, and households are really saying, gee, we've got problems. Now, if you look forward 2 years or so from there, my expectation is that we're going to see higher levels of default later as well.
For sure, and that leads us to this next slide here when we talk about households still consuming above that income and savings rate because their wages aren't going up.
Yeah, that's right. There's a really interesting speech from Phil Lowe yesterday from the RBA talking about the fact that the wealth effect is under a little bit of pressure, but people take a longer term view of things, right? So in other words, if they think they're going to be better later, they still may well spend more. They still may suck their savings out to go spend it. But you can't go on doing that forever. And the point is that the savings ratio still looks pretty sick. And so what we're finding is that those households who have savings, who have equity in their property, are pulling it out and are still spending it. But that will only go on for a limited amount of time. And as we'll see on the next slide, we're beginning to see a turning point now.
Yeah. So next up with here, we've got that per capita recession, as you put out in the headlines yesterday. And for those people at home, that just means that we've got more people coming into the country, but the economy is not outpacing it with its growth.
Yeah, so you can argue whether GDP is a good measure or not, but frankly, it's the measure that everybody uses around the world. And so, effectively, the latest results yesterday that came out on a trend basis, it was last quarter 0.3%. On a season-adjusted basis, 0.2%. That's a very, very low, and that means that the GDP number on an annualized basis over the last 12 months will be 2.3%, which is way below what the RBA thought it was going to be. They thought it was going to be 3%, right? But on a per capita basis, so this is effectively isolating the impact of more migration. In other words, more people. We've actually now, for the second quarter, gone backwards. And that means that on a classical definition of a recession, which means 2 quarters of negative growth, we are actually on a per capita basis now in a recession. That really doesn't bode well going forward. And if you look at the numbers in detail, essentially the only thing that is now supporting the economy is massive government investment in infrastructure.
Yeah.
And that's both at a state and a federal level, a bit from the mining sector. But the household sector has really come away. So retail is very weak. Households are spending less. We discussed that simply because they don't have the ability to spend so much. And this means that the forward view now in terms of what the GDP number will be, in other words, the growth rate, will be a lot lower. And now, of course, that's coming to the election, right? So there's now really a stronger case probably for a rate cut from the RBA. And some people are even saying maybe it'll be next month. My own view, probably later in the year. But yeah, the economy is looking pretty flaky at the moment, really only firing on a couple of cylinders. And the main cylinder is government infrastructure investment. Now, of course, the point about that is you have to borrow to make that work. So whilst the government may be able to claim that they'll be, on a cash flow basis, if you like, running away from a deficit and towards positive in the budget coming up, the underlying debt is still growing, and that is a big problem.
And I think that's really important. We touch on this in the whole chapter in our documentary about a lot of people saying, immigration will save us. So many people want to live in Melbourne and Sydney, but it's not as simple as just, hey, let more people come to your country and it'll boost our economy.
No, in fact, what you do is you end up basically crowding the place out, but you don't necessarily, for most people in the country, it doesn't actually bring any positive results. It actually just makes more difficulty in moving around, and the economy may look superficially a little stronger as a result, but really it doesn't necessarily help.
Sure thing, yeah. So next up here, we've got home prices continuing to fall, and a lot of people on the mainstream media were calling that the bottom was in February. We saw a bit of an uptick in auction clearance rates and a few other metrics, but no sign for the bottom as far as you're concerned, Martin?
No, the clearance rates are on such low volumes, it really doesn't mean very much. And often we found after the Christmas break, there'll be a slight move up. And I think it's going to come back to more normal, normal levels, which are very low clearance rates on low volumes. But home prices are continuing to slide. They're down 12% in Sydney, 10% in Melbourne. And the problem is that now we've got discounting in Sydney is bigger than it's ever been. In other words, the asking price relative to the price that's settled.
Yeah.
And in fact, nationally now, we're seeing a smaller number of suburbs where the average price is above $1 million. So that's another indicator of significant downward pressure. In fact, home price falls are broadening. Most centres are actually now experiencing falls other than perhaps Hobart, although that may come through later. Even Canberra now is looking a little bit more wobbly too. So effectively, there's no end in sight, in my view, to the home price falls.
Yeah. And that leads us to your summaries. The most likely outcome still remains between 20 and 30%, but that's really without anything else happening. And we won't go into it too much today, but we're starting to see global weakening, talk of Canada in recession, Germany slowing down, and that could hit Australia as well.
Yeah, look, if nothing internationally goes really badly wrong over the next couple of years, I still think 20 to 30% peak to trough in Sydney and Melbourne is probably what we're going to see. It might be a little bit more. But if we get an international crisis of some sort, it could go a lot worse. So we are in a rather precarious situation. But remember, a lot of this is of our own making. We've had interest rates too low. We've had credit too available. And trying to pull back from that in the current environment is going to be very difficult. So that's why I'm convinced that we're going to see further home price falls over the next 12 months or so.
Yeah, and I think one of the contributing factors is going to be the political butting of heads, that not a lot is going to get done. And I think the RBA are going to be hesitant to cut because it was only a couple of months ago they were talking about rate rises and they don't want to have, egg on their face. So I think everyone's just waiting, looking around for something to change, and that just gives it more time to decrease.
Yeah, and the RBA in that speech yesterday argued that the reason home prices were falling was to do with the fact that we had big migration coming in, so there was a big demand that pushed prices up. Then we had a building boom, and that produced more supply, so that basically put downward pressure on home prices. So that's the real reason why home prices are falling. Frankly, they're missing the point. It's all about credit availability, as we discussed earlier, and the fact that credit is still much tighter now. The lending standards are tighter. The credit impulse is easing. That's the real reason why home prices will go on falling.
Absolutely. So household wealth is still falling. Main contributing factor obviously being the value of your home, Martin.
Yeah, this is a big deal, of course, because households feel wealthy when house prices go up and are likely to spend more, but the reverse is also true. And again, now we're seeing the negative wealth effect. So people are keeping their money firmly in their pockets or in their wallets. And as home prices continue to fall, despite the fact that we've seen stock markets begin to recover because of the change in the Fed, over the last month or so, it's really about home prices. And unfortunately, I think we're going to see more wealth negativity over the next few months.
Yeah, and another episode that I'm working on is about that central bank stimulus and how it's flowing into other countries. And the US have printed a lot of money, but it's gone into their assets. Whereas in Australia, even if we print a lot of money, we spoke about this in the documentary, I don't think it's just going to keep flowing into Australian banks and construction and those sort of limited assets we have in Australia. So Australia's super accounts, their financial assets, I don't think that is going to get as big a boom as we've seen in other countries, even if we do print money.
Correct. I think that's exactly right. I think we've got, we're almost out of ammo. That's the real problem, I think.
Yeah, cool. So business investment, and this is the one that we want to see getting that uptick, particularly in the tech sector and things that we spoke about, but business investment is still slowing.
Yeah, it is, unfortunately, and all of the feedback from my surveys indicates that, in fact, businesses are getting really twitchy now because, of course, a lot of them are directly connected to the consumer sector as well. So whilst there may be some big investments from international firms, particularly some mining investments, more generally, it's looking pretty sick, I think, and unfortunately, that means we don't have another growth story, which means that effectively the economy will continue to sag.
Yeah. And final slide here, Martin, we've got that the bank funding, and it has eased a little bit, but we've still got a reasonable gap there.
Yeah, that's right. So this is just the last slide. So this is the BBSW. Now, it tends to sort of drop down the end of the quarter and then pick up again. But this is reacting to the Fed's news that effectively they'll keep rates a little lower than perhaps we were expecting even 3 months ago. But nevertheless, the banks in Australia are still struggling with their funding. They've still got a gap to recover. And that tells you that even if the Reserve Bank decided to cut the interest rates, that wouldn't necessarily get all passed on to borrowers because of this funding problem. So I'm watching this slide quite closely because I expect to see the funding rates begin to move up again. And even if they stay at this sort of level, then we've still got a deficit amongst the banks in terms of their funding, which means that they've got limited ability to move. And of course, they're also deeply discounting rates for new borrowers to try and suck them in.
Yeah.
So to my mind, this is all telling me that we've got some tricky times ahead.
Yeah, and for people at home, I just want to talk about this a little bit more. So when Australia had higher rates, when the US and particularly Europe was at the zero bound, it was like having a high interest savings account. We'll park a bit of money in Australia. Now the US is up over that 2% mark and looking to raise rates, and Australia is talking about dropping them. There's even more reason to suck any money that is parked in Australia out of the country.
Correct. Yeah. So international investors are looking at Australia now thinking, yeah, not looking so good. Now, okay, the Reserve Bank can flex the exchange rate perhaps to make it look a little more attractive, but even that has implications in terms of importing inflation. So we are, I think, looking at a really uncomfortable period over the next 6 months or so.
Fantastic. Well, thanks for joining us today, Martin. Any final thoughts for everyone at home?
No, I think other than to say, keep watching the data because effectively this will give you the best indication of how this is going to play out. A lot of the information from public sources are, of course, quite delayed. So it's really important to look at that forward-looking stuff, like our surveys, for example, and our confidence indicators, because those are the ones that will give you the best forward indications as to what's likely to happen.
Fantastic. And good luck with it all, Martin. You're doing a great job in the media.
Thanks for that. Well, good to share the information with you and your viewers.
Thanks, guys.